My name is Howard Schwartz, and I'm going to talk to you a little bit about casualty losses and Ponzi schemes. Now, Ponzi schemes are heavily in the news right now, especially with Bernie Madoff and a couple of others. And Ponzi schemes, we all know how they work pretty much, but there's also some IRS, Internal Revenue Service, rules relating to Ponzi schemes. In fact, because of the preponderance of the Ponzi schemes recently, the IRS has created some new rules. And there are a lot of planning opportunities around them. They're not simple, and they have to be reviewed on an individual basis to maximize the benefit. Ponzi schemes are part of the general rule of casualty losses. So that's the first step. We've got to take the backdrop of how does a casualty loss work. And generally, casualty loss is limited to the lesser of the fair market value of the property at the time of the loss or its original cost. So if something cost $1,000 and today it's worth $500, your loss is limited to $500. If something is originally cost $1,000 and is now worth $2,000, like art or antiques, your loss is limited to the lesser of, which is the cost in that situation. Casualty losses also have other restrictions. In other words, if the casualty loss is $1,000, you're limited, you must reduce it by 10% of the loss. So you lose $100 automatically. Plus, no matter what the size of the loss, you lose the 10% and another $100. These are not the same laws as Ponzi scheme theft losses. Now, the IRS has created this new review for Ponzi schemes, and they've called them theft losses. They've given us a lot more flexibility, and they've given us some safe harbors. They've also given us some restrictions. Some of the alternatives that we have. Well, one is to amend prior year returns. Well, we know that prior years can be amended for 3 years. We can amend prior year return for 3 years. Somebody misstates their income, forgets to take a large tax deduction, they can go back 3 years and restate their income by filing an amended return. How would that work in a Ponzi scheme? Well, let's say I invested $1 million with Bernie Madoff, and he has been giving me a 1099 each year for the last couple of years, and each one of those 1099s show that I made $150,000, 15%, let's say. Well, I filed returns showing $150,000 worth of income, but that never occurred because 3 years later, this year, 2009, I found out that I really had nothing. And when I reported those 1099s of $150,000 a year, I overstated my income. The IRS has given us a safe harbor, so put that in your pocket for a second, because the IRS has given us a safe harbor, and they said, we're going to give a low audit review process if you forego amending those prior year returns. That doesn't mean that's the best plan. It means that's the safe harbor. Don't go back, don't amend. Take the last statement you have, which includes all of the accrued original contributions, growth and capital gains growth. Remember, capital gains growth would be taxed at a very low percentage, 15% generally, and ordinary interest and dividends, which would have been taxed at their various rates. Interest is taxed at your highest rate, dividends at 15%. And take all of that, and no matter what the source and how it's been taxed, even capital gains rate at 15%, or even dividends at 15%, we're going to allow you to take that last statement, which accumulates all those numbers, and write it off as a theft loss, which is ordinary loss, 100% ordinary loss. Well, that sounds like a pretty good deal. So why wouldn't I do it? Well, going back and amending the prior year returns gives me lesser income in those years and gives me an immediate deduction. If I don't do that and I take the current statement, that my last statement that had anything prior to my Ponzi loss, and deduct it, I could create an NOL. Now, that's okay because I could wipe out all my income in this year. What does that do? It wipes out a lot of income at the highest level, some income at 30%, some income at 25%, some income at 15%, some income at the zero level. Not always the best planning idea. And then I've got to take an NOL either back or forward, and NOLs create alternative minimum tax. So you've got an additional tax on top of the deduction you're trying to get. Each individual, every case is different, every case has got to be analyzed specifically. But there is that safe harbor, gives us some safety. I don't know if it's always the best way to go. Generally, if you've got a loss, you're going to find your loss on the last K1 that was given to you by the partnership. K1 from the partnership is going to show some ordinary income, some business income, some interest, some dividends, some capital gains. Or in this case, when the Ponzi scheme is discovered, that next K1 is going to give you all those things in the negative. Loss, 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 loss. All the losses of interest that you've taken, all the losses of dividends you've had, all the losses of capital gains, they're all going to come out as this theft loss. It's going to be a minus on that K1. If your ability to take that K1 is limited, number one, it's limited by a couple of things. It's a different number than the theft loss you're allowed to take. The K1 and the theft loss are two different things, and you've got to analyze them individually. Also, if you're going to make a claim, like a SIPC claim or a claim against the trustee for Madoff, the receivership, if you're going to make a claim of any kind against a third party to try to recover some of your loss, you cannot take more than 75% of the calculation. Not exactly the K1, it's a different number, but the calculation that's got to occur. If you're not going to claim a loss against a third party, including SIPC, then you can take 95% and still qualify under the safe harbor. That's what the give-ups on the safe harbor are. Lastly, you can also file and elect against the K1. So the K1's got two things on it. One, it's going to give you your capital account through the end of the period right before the Ponzi theft loss. And it's also going to give you in a separate section all of the negative amounts that they think, the preparers of the K1, of the partnership, think that you're entitled to. You can elect against what the preparers think and go against the capital loss in the capital account by filing a special form, which is an election against the K1. But you have to do that specifically. As you can see, there's a lot of complications. It's not easy. There's a lot of decisions and a lot of cross calculations that have got to be made. And then, even if you wind up demonstrating a benefit in one case versus another case, taking the safe harbor versus not taking the safe harbor, electing to go back versus creating your loss in the current year and creating an NOL, which will affect your prior years or future years, depending on how you elect. Even after all that, you've got to sit down with the client and explain the risks associated with their decision, and they have to be involved in the decision. Thank you.